Now, when you're first sort of getting into FX trading or trading financial markets, you'll often see bond prices reported, spoken about, and there's this sometimes intensity of what can seem like totally unrelated information. You're trading FX, and all of a sudden you read a large article on the US Treasury bond market, and the implication has strong uh, bias for the dollar in the next coming months. And quite frankly, you're left a little bit confused. So if that's you, this video is for you. The bond market tends to be a market that's looking far into the future. Now, that there's some caveats to that. If you're a medium-term bond trader and a longer-term bond trader, you're looking at larger trends. Anything from sort of 10-year and upwards. 10-year, you're looking out into the future. Now, if you're sort of a short-term bond trader, you're looking at near-term monetary policy decisions from the Federal Reserve. So the bond market has different times for different bond markets. So it could be a 6-month, a 3-month treasury, or it could be up to 10, 20, 30 years. So that's called the yield curve. And what FX traders are looking for is certain moves in that yield curve to indicate what bond traders are thinking about interest rates, both short term and longer term. And there's a saying that says the bond market is the truth. And what that means is bond traders tend to be steady, longer term investors, maybe a huge pension fund that wants to allocate a large part of their portfolio into bonds. And so they're not sort of so worried about timing the market correctly to the right week or the perfect month for make a purchase. They still will be thinking about a general picture they're expecting to play out over an extended period of time. So, things to take away from it. Number one, bond traders are highly sensitive to interest rates. And now you see why FX traders are looking at bond prices, because the bond market is a good indicator of what bond traders think about interest rates and whether they're rising or falling. So FX traders will always look at the bond market because it helps them see interest rate expectations from those steadier hands, those potentially steadier bond traders. Although in current market conditions that could be questioned. But let's keep to the big picture. And the big picture is significant moves in the bond market will have significant moves in the corresponding FX market because of those interest rate expectations. So, for instance, when we suddenly saw a huge drop in UK gilts recently, we saw a significant drop in the pound. When we saw a huge drop in US 10-year yields, that's a bid into bonds, then we saw a corresponding drop in the dollar. Now, there are sort of other minor points to this, and there are situations where you can see the opposite reaction. So you can see yields rising, but a country's currency falling. But that's really only in times of distress, and it's a different situation that's best dealt with when it's happening. The basic relationship is falling yields, falling currency, rising yields, rising currency. That's the general rule of thumb and the place to start with. And just to know that if you are an FX trader, you should dare I say it, you must be looking at bond prices so you can get a sense on what bond traders are thinking of latest economic data moves and whether they're really as significant as others are perhaps saying. The bond market tends to reveal significant players' hands and what they think.